Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of multiple ratios, those ratios including current ratio, quick ratio, debt to total asset, asset turnover, average daily credit sales, average collection period, accounts receivable turnover, and average collection period. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to, but if you have access to it and would like to, we are in the 332 Multiple Ratio Calculations tab under the Practice Problems section. Now, closing this back out, we're going to see our information up top. We'll go over all the information first, then we'll take a look at pieces of that information that will be necessary as we go through our practice problem. So the information will include sales, percent of sales sold on credit, 70%. Then we have the assets, which will include cash, accounts receivable, inventory, plant and equipment. We have the total assets. Then we have the liabilities and equity, accounts payable, accrued taxes, bond payable, and then we have the common stock paid in capital, retained earnings, total liability, and equity. So in essence, of course, we have our balance sheet here being in balance, total assets equaling the liabilities and equity. Note what we do not have here are subcategorizations of current assets and long-term assets, or current assets and property, plants, and equipment, or depreciable assets. We didn't break out those subtotals because we want to be able to practice when we look at these ratios which numbers to pick up when we're thinking about something that has a current assets calculation in it or a quick assets type of calculation in it. Same for liabilities and equity. We've combined them together here, so there's no subcategorization of liabilities, current liabilities, or the equity section, so that we can practice pulling these numbers out without those subtotals and be able to add up and recognize which categories those subtotals go into when working these ratios. We're going to have a smaller portion of the data here. So we've got the sales, here are the assets, and then the liabilities and equity bottom lines on the balance sheet being the same. We'll use that to calculate our ratio so we can get to it a bit more easily. All right, so we've got the current ratio. This is one of the most common ratios that people actually learn usually, because most of the time when people are looking at this, they're often looking at solvency. Is the company going to be able to pay off their debts? This is often what a banker will look at. Obviously, the management within the company wants to know this as well to make sure that they have the cash flow necessary or the current assets necessary that will generate the cash flow to pay off the current obligations. So we're going to be comparing then the current assets and the current liabilities. Now, the current assets, remember, are those assets that are going to be more liquid assets. Those things are going to be used sooner and or be able to translate to cash easily. And then the current liabilities represent those liabilities that are going to be due within a year's time period. So therefore, they're going to be due soon. That's an arbitrary cutoff. We just cut it off at a year. 12 months later, these things will be due. And that's going to be a short-term period, so we want to make sure that we have the current assets necessary to pay off any obligations that are going to be coming due in a short period of time, which is going to be a year. So the current assets, then what are the current assets here? We've got cash is going to be very liquid. That's a current asset. Accounts receivable is a current asset. Inventory is going to be a current asset. Plant and equipment, those are depreciable assets, not current. Those are things that we cannot pay off our current obligations with because they're going to be long-term items. And you might say, well, you can get a loan against like a car or something like that, or building, but they're not easily translated into something that we can then pay off our debts with. Therefore, they're not included in the current assets section. We want them, they're important things, but they're there to help us generate revenue, not to help us to pay the current obligation debts. So we're going to have the 40,000 plus the 303,000 plus the 294,000. That's going to give us the 637,000. Then we have the current liabilities. Those are going to be due within a year. So accounts payable typically is going to be in there, of course, because that's going to be our normal payable for purchasing things. Normally things like inventory. And then we got the accrued taxes. Those are taxes that have been accrued because we made money. And then the IRS wants their, or the tax agency wants their portion. We haven't given it to them yet. They're going to want it within a year. Bonds payable. Notice bonds payable, unless told otherwise, we'll consider it long-term oftentimes because the period will typically be long-term. We don't often have a a current portion of it because we're going to be paying off the entire thing at the maturity date of the bond typically. So it says long term here. So that means our only current assets are going to be these two. We're going to take the 298,000 plus the 128,000. That's going to give us the 426. If we do our calculation, then we got the 637,000 divided by 426,000. That's going to give us our 1.5 about, because we're rounding. This 9 goes up and that brings up the 5 here. So 1.5. Now, obviously, if we want this thing, if you're like a banker, to be higher would be better, right? Because that means that you can pay off your current obligations, so obligations that are going to be due within a month, 1.5 times, 1.5 times over with the current assets. So that the more you can be able to pay off your debts with the current assets, the more likely you will be able to do so, and the more solvent you will be. Now, like we've said in the past, normally you want to compare these kind of ratios to industry standards and to ourselves in the past, but this isn't as much a performance ratio as a liquidity ratio. And the bottom line is that you definitely want this thing over 1, because if it's less than 1, then that means that you don't have not only the cash but receivables or inventory to pay off the obligations that are going to be coming due within a year, and that could, that's a problem. So you're going to want to think about, how could you get some more cash flow going, or some assets that are more liquid that you can pay off the obligations that are going to be coming due soon, or you can think about how you can take some of those current assets and possibly make them more long-term, or those current liabilities and make them long-term in order to improve the liquidity in the short run. So then you might say on this, you might go, okay, well, there's the current asset ratio, but what if like there's a catastrophe or something happens, so there's some drop in the market and you can't sell the inventory because, something dropped, something happened, no one's buying the inventory. Then would you still be able to pay off your current liabilities that are going to be coming due in a year, even if there's some kind of problem like that? So therefore, we're going to use the quick ratio, which is going to make this a more restrictive type of ratio. So we're going to say, okay, now we're just going to compare the quick assets, which are going to be simply, in our case, the 40,000 cash, and then the accounts receivable, 303,000, and that's going to be the 343. And then we're going to compare those to the same current liabilities, those becoming due in a year, which was the accounts payable and taxes, same number here that we had up top, so I won't calculate it again. And there we have our ratio. So now we're going to be taking this, we're going to say, all right, 343,000 divided by 426,000, and now we get the 0.81 about, if we round it here, So note, now here, you're looking at this. Now this ratio is always going to be either equal to or less than the current ratio. That's how it's designed to be. It would only be equal to if there were no inventory. Like if you didn't sell inventory, then it might be the same number there, right? But if you sell inventory, then you're going to have some inventory, and that means that this number is always going to be lower. That's because it's a more restrictive calculation. That means that our current obligations, if we weren't able to sell any inventory, then we wouldn't be able to pay off the current obligation. So we're kind of in a year, right? Because the current liabilities are greater than the quick assets. So again, you'd want this thing normally to be at least over 1, because that would give you some cushion to be able to say, okay, even if there was some big problem and I couldn't sell my inventory, I can at least pay off the debts in the year. So if you're a bank, or if you're the company, you're typically thinking that the higher the number, this would be better. It gives you more cushion to make sure that you can pay off those current obligations that are going to be coming due. Okay, so next we're going to have the debt to total assets. That is just what it says, right? Debt compared to the total assets. These are going to be two balance sheet accounts. So we're taking the liabilities then, that being the debt. So we're going to take all the liabilities now, and I'm going to add up all the liabilities, the 298,000 plus the 128,000 plus the 122,000. That's our debt, and we're going to be comparing that to the total assets. Now, if you think about this in terms of the accounting equation, assets equal liabilities plus equity. So assets is what the company has, and they have those assets either through financing it. You can think about it this way, financing it, or the owner got the assets, or we generated revenue, equity, right? and it was either return on assets that generated equity or the liabilities. So in other words, the liabilities, third-party claim, or equity are the two people or categorizations of folks that have claim to the assets. You can also write that as assets minus liabilities equals equity, and or you can write it as assets minus equity equals liabilities, which is far less common. But the point is that if you then compare the liabilities to the assets, you're comparing the amount that the third party, the loans that are out there, have claim to the assets, to the total assets, and you're dividing that out. So we're comparing then total liabilities, and when you see debt, you're typically thinking liabilities compared to the total assets. And we're going to say, all right, let's take a look at that calculation just to see the rounding for it. The calculator got a little squished up there. Let me pull it out like this. Okay, so 548,000 divided by the 1126000. Moving the decimal 2 places over, that would give us then the 48.67% about. Now, again, this ratio is one that people have debates on as to how high you want the leverage to be. And the two kind of arguments you can think about this, you could say, well, some people will argue, well, if we're getting a good return on the assets, then if you can increase the liabilities, then that means the owner doesn't have to put in more capital themselves. You're increasing the liabilities, which will increase the assets. And if you're getting a return on the assets that's sufficient to clear any financing or the interest that you're going to be paying on the loan, then that's gonna be good, right? Because you're going to be increasing your return. You're going to increase your assets, and that'll increase the return that you can have. However, of course, a lot of people, once you get to a certain point and that's called leveraging the company, a certain amount of leverage. If you go too much, the more leverage you have, then of course, then the more risk you have at the same time. So if you're over leveraged at some point, you're going to then have a problem if there's a downturn in the economy. If there's a downturn in the economy and you're over leveraged, then you might not be able to get the return on the assets that you've been expecting under good times. And you might not be able to get a loan at that point in time, given the fact that there's a downturn in the economy. So there's kind of a debate in terms of what's the right spot over the amount of leverage that is going to be necessary. Now, if you're talking to a bank, of course, that's thinking about giving a loan or something like that, they would like this number to be less. You'd like this number to be lower, because that means it wouldn't be overly leveraged at that point and might be more likely to. Also note that if you're talking about liabilities over equity, if you take this number minus 1 or 1 minus this number, so minus 1, then that's going to be the amount of equity compared to the assets. That would be 51% about, would be the amount of the total assets that are categorized or that the owners have claim to. So just note that if you know one of these, either equity compared to assets or debt compared to assets, you can figure the other side out as well. We have assets turnover. So asset turnover is going to be sales, top line of the income statement, sales divided by the total assets, which is going to be here on the balance sheet. So this is one where you're comparing an income statement number, performance number, which has a range of time. It's calculated over a range of time, as opposed to the total assets balance sheet number calculated as a point in time. So you might see this average total assets, sales divided by average total assets. So be aware of that. So we're trying to see how efficiently, now this is a kind of like a performance measure, how efficiently are we using the assets that we have. So we have 3,110,000 divided by the 1,126,000 is going to be the 2.61 about. So that's the turnover. We would want this item to be higher. So the higher this would be, the higher this item is, the better. And again, we're kind of measuring how well we are using the assets. Now, this is a number that we would want to compare to industry standards to see how well we're doing, as well as to past performance. And notice if you look at the total assets here, if we're able to get a good return on the total assets, then you'd probably comparing this item in the debt to total assets, thinking, okay, if we were to take out a loan in order to generate more assets, if our asset turnover is good, we think that we can generate a return on those more assets, then that would be one of the kind of things you'd be thinking about as to think about as to whether you should be, adding leverage to the company or taking in more debt in order to increase the assets. Because obviously, if you want to increase the assets, there's two ways you do it. One, you take out a loan, or two, you get the equity somehow, and you get the equity by either owners putting money into the company or through generation of revenue. Okay, so then we're going to go back down. We're going to go to the average daily credit sales. So average daily credit sales, we're going to be taking our sales number, which is going to be the 3110. We will then take the credit portion of it because we're looking for the credit sales. So when we make sales, we can make sales on credit, meaning we kind of send out an invoice and we're going to collect on it in the future, which means it's going to go through accounts receivable, or we could have cash sales. Now, if we have both credit and cash sales in the type of business we are in, then we need to estimate the amount of our sales number that was credit related sales, those sales that are going to go through accounts receivable. So let's just pull up the calculator just so we can follow this along here. We got the 3110000 times 0.7. So if I move the decimal over, we'll take a look at the decimal. We got the 2,177,000. And then we're going to take the days in a year. Now, when we think about the days in the year, you might see this a couple different ways. You might see it as 365, estimating the most common year, average of the most common year. Or the days could change for of different years, or you can try to round this thing out, which is something we often do when we do statistical type of analysis. Try to make all the units the same, right? So if we're trying to make all the months the same, we're going to say 12 months times about 30 days a month, and that would give us the 360. So just note that you might see 360, you might see 365. Again, it just depends on the context of what you're looking in and where the calculation is coming from and what you're using it for. So then we have the average daily credit sales, which of course then would be the 2,177,000 divided by the 360, that being 6,047 average daily credit sales. So that's on every average day, we're selling about 6,047 of sales on credit. And then if we take that, we can then calculate the average collection period. So how long does it take for us to collect on it by taking the accounts receivable on the balance sheet? We're going to be dividing that by the number we just came to, the average daily credit sales. So let's do that. We're going to say, all right. Then we've got the 303,000 divided by the 6,047. That's going to give us our 50.11 about, and that's the average collection period in days. So notice this number is a little bit more concrete than you might see with the accounts receivable turnover, in that people can kind of visualize the amount of days a little bit easier. Obviously, we want this number to be lower because we want to be collecting faster. So we want to be collecting our receivables sooner. That will increase our cash flow, and it'll also make it more likely that we will actually be able to collect on the accounts receivable. Now, we could calculate this number another way with the help and the use of the inventory turnover. So we'll do that here. So let's take a look at the accounts receivable turnover. Accounts receivable turnover is the credit sales, and we're just going to pick up the same credit sales we had up here, which was the total sales times the 70% credit sales, 2,177,000. And then we're going to compare the credit sales to the accounts receivable. The accounts receivable being the 303. So we get our turnover. And remember, we're now comparing, once again, a income statement account, which has a time range, balance sheet account, which is a point in time. So you might see this as average accounts receivable, most common average, beginning of the period plus the end of the period divided by 2. So now let's take the 2,177,000 divided by 303. That gives us our 7.18. 7.18. Now this number is a bit more arbitrary because we kind of need to compare this to industry standards or past performance for us to really kind of conceptualize that. So the turnover is a really important number, but we kind of need to see it oftentimes in context to conceptualize, how effective it is. But obviously, this is a turnover number. We want it to be higher because a higher turnover number would mean that we're collecting on our receivables sooner. So we would obviously want the sales to be going up and the accounts receivable possibly to be going down due to the fact that we're collecting on the receivables faster. And then if you go down, now we can calculate the average collection period again, which we already did, but we can do it a different way now. Taking the days in a year, 12 months times 30, and then we can divide that by the accounts receivable turnover, this number we got here. Now, this way of calculating it is probably less intuitive than what we just did, calculated it before. Let's do this real quick before I get into that. 360 divided by 7.18, that's going to be the 50.11 about. That 50.11 is going to be the same number we got to up top here. Now, this first way we got to it, calculating the average sales, and then comparing the accounts receivable to the average daily credit sales was probably more intuitive. It is to me. So I used to, when I started learning this stuff, I would say, well, that's the way that makes sense to me. I'm just gonna go with it on that way, and that might work in practice, but but in a book problem, they might just give you the information and you'll have to do it basically this way because that's all the information they gave you. And if you can do it this way, if you can learn it multiple ways, then of course that's better in practice as well, because that means you got a better grasp, understanding of the relationship of these things. And that means the ratios are probably telling you more than they're telling somebody else that doesn't have a good understanding of the relationship. They just know how to calculate and get to a number, which doesn't mean much to them. Right? The more it means to you, the more you understand it, then the more actual information that you get from it that might improve your decision-making process.